Welcome to the Deep Dive. We're here to pull out the most important insights from corporate calls and research for you.
And today, we're looking at Huntington Bank shares. Their recent Q3 2025 earnings call really stood out, didn't it? Especially given all the anxiety around regional banks right now.
It definitely did. So the plan today is to really distill that call for you. We want to get past the noise and focus on the core numbers, yes, but also what management is saying.
Exactly. Things like how they're handling credit risk worries, what the Veritex acquisition really means for them going forward, and crucially, how they managed to sound so positive on guidance when, others are pulling back.
Right. Our mission here is pretty simple. Give you the absolute essentials, the key metrics, the strategic shifts, so you're immediately up to speed on what makes Huntington look, well, different in this environment.
Okay, let's jump in.
Let's start with those headline financials, because honestly, they paint a picture that's quite different from the sector narrative. Adjusted earnings per share for Q3. 40 cents. That's up 18% year over year. 18%. That's a pretty strong number in this climate.
It really is. And it's not just a one-off EPS beat,
Yeah.
It suggests real momentum compared to peers who, frankly, struggling to stay flat. And that strength flowed through. Revenue was up 14% year over year.
Which then pushed up their adjusted pre-provision net revenue, PPNR, by 16%.
Right, PPNR. And just for you listening, think of that as their kind of core operating profit before loan loss provisions.
Okay.
So a 16% jump there, that signals real internal engine power.
And tangible book value saw growth, too.
Yep, TBV grew 10% year over year. And maybe most impressively, their adjusted return on common equity, ROCE, was reported above 17%.
Okay, above 17% ROCE is, well, strong. Management called the quarter outstanding, talked about tremendous momentum. But, the market is still spooked about regionals. Is this sustainable? Was there anything unusual boosting that number?
That's the natural question, right? And management seemed ready for it. They didn't just say it was outstanding. They backed it up by raising full-year guidance on several metrics. They believe it's durable. And they pinned it on three core strategic pillars they kept highlighting.
Okay, what were those pillars?
Well, first, just plain execution. They stressed they're executing their growth strategy and genuinely outpacing their peers in both loan and deposit growth.
Okay, execution. Makes sense. Pillar 2.
Achieving top-tier profitability and returns. That 17% plus ROCE wasn't an accident, they argue. It's the result of better operating leverage.
And the third pillar, that must be about the future. Texas.
Exactly. Pillar 3 is all about accelerating growth, specifically in Texas, leveraging that Veritex acquisition. It's about building scale intelligently while others might be, pulling in their horns.
Right. Let's dig into that growth a bit. Average loans were up, 2% from Q2?
2% sequentially, yeah, which comes out to 9.2% year-over-year growth. But here's the really interesting part. Nearly 40% of that sequential growth, about $1.2 billion, came from completely new initiatives.
Wow, 40% from new stuff. So this isn't just riding on old relationships. You mentioned Texas, Carolinas.
Yeah.
Is that where it's coming from?
That's a big part of it. The geographic expansion, Texas, obviously, with Veritex coming online soon, but also the Carolinas, and also some specific business lines like funds finance showed real strength.
Okay, so loan growth is solid and strategically driven. What about funding it? Deposits?
Deposits also grew, though more modestly. Average balance is up about 0.8% sequentially. But the critical metric here, and this is impressive, their overall cost of deposits actually fell by 2 basis points during the quarter.
Fell? In this environment, how?
It suggests they're doing a really good job managing deposit pricing and, importantly, holding on to those core, sticky, primary banking relationships, not just chasing expensive hot money.
Okay, so growth seems solid, funding costs under control. But the big question for every regional bank right now is net interest margin. How did they do there? Because that's where the pain has been sector-wide.
They did well. NEM for Q3 came in at 3.13%. That's actually up 2 basis points sequentially.
Up 2 basis points? Okay, that's positive. But the real buzz seemed to be about the forward look on NEM.
Absolutely. This is probably the most important differentiator. Management confirmed they've maneuvered into what they call a near-neutral asset sensitivity position. For Q4, they expect standalone NIM to nudge up another 1 to 2 basis points.
Okay, 1 to 2 BPS is okay, but I saw a forecast for 2026. Something like 10 basis points of NIM expansion. That sounds almost too good to be true when everyone's bracing for potential Fed cuts. How are they projecting that?
Yeah, that 10 basis point number for 2026 is the headline grabber. And they modeled it holding up even if the Fed cuts anywhere from 0 to, get this, 7 times.
7 cuts. And NIM still expands. What's the mechanism? It can't just be hoping rates stay high.
It's not based on rate predictions at all. This is the core of their unique position. And it's actually pretty straightforward, fixed asset repricing.
Ah, okay. So older loans rolling off and repricing higher.
Exactly. Think about legacy commercial loans or mortgages that were booked years ago at much lower rates. As those mature, they're being replaced or repriced at today's significantly higher market rates. It's like a built-in, guaranteed uplift to their interest income stream.
So it's less about where new loans are priced and more about the old book turning over.
Precisely. And that mechanism alone, just the repricing of the existing fixed-rate book, is estimated to contribute about 7 basis points to NIMIC expansion in 2026. It's a tailwind baked into their balance sheet that many other banks just don't have to the same degree.
That makes sense. It's a powerful structural advantage against that macro uncertainty. And it explains why they felt confident enough to raise their full-year standalone net interest income, NII, guidance by 2 full percentage points. Now they're expecting 10 to 11% growth for the year.
Right. And it wasn't just NII. Fee income guidance got a bump too, now looking at around 7% growth for the year. Strength in payments, wealth management, capital markets, it all contributed.
And efficiency. You mentioned operating leverage earlier.
Huge story there. They're clearly focused on cost control, and it's delivering big time. The full-year outlook now points to more than 250 basis points of improvement in their efficiency ratio.
Wait, over 250 basis points? Wasn't their original target something like 100 basis points?
It was. They started the year aiming for 100. So hitting over 250 shows a massive acceleration in finding those efficiencies. They're really leaning into it.
Okay, efficiency improving dramatically. And then they're adding Veritex. That deal closes soon, right? Next Monday?
Yep, slated for next Monday. And that immediately gives them significant scale in Texas.
What does significant scale translate to?
It makes them the 14th largest depository in Texas overall, and crucially, number 5 in the Dallas market. That's a big footprint jump.
And the expected financial impact? Synergies.
The cost synergies alone are projected to improve the combined bank's efficiency ratio by another full percentage point that's on top of the 250 basis points organic improvement we just talked about. And it should add about 30 basis points to their ROCE.
And near term. Any impact in Q4?
Yeah, they guided to about a $20 million core PPNR benefit just from Veritex in Q4 alone. That works out to roughly an extra penny in EPS.
Okay, let's pause here. The numbers look great. Guidance is up. They seem to have this structural NIM advantage. So why the disconnect? Why is the market still treating Huntington and really the whole regional sector with such caution? It has to be credit fears, right?
It absolutely is. Credit risk is the elephant in the room for all regionals. Management knew this and spent a good chunk of time defending their asset quality.
What were their main defense points?
Well, first, the current metrics are still strong. Net charge-offs are low, just 22 basis points. But more fundamentally, the CEO really leaned into their history, emphasizing a 15-year track record of maintaining an aggregate, moderate to low-risk appetite. They're arguing this isn't a new thing. It's embedded in their culture and shields them now.
Did they address the specific scary headlines we've seen lately? Things like alleged fraud, collateral issues at other institutions? That stuff spooks investors.
They did, quite directly. Their answers circled back to rigorous client selection and focusing on deep relationships, not just transactions. They actually mentioned passing on deals that were involved in some of those recent problem headlines.
Passed on them.
Okay, that's a concrete example.
Yeah, and they also specifically addressed non-deposit financial institutions, NDFI. That's an area the market is particularly worried about.
Right, NDFI lending. That's seen as higher risk, maybe lending to private equity funds, specialty finance, that sort of thing. Exactly. It can be profitable, but also blow up quickly. Management stated their NDFI exposure is minimal, around 2% of total loans, and that's excluding their highest-rated investment-grade clients within that. They said they feel very good about that low exposure. It's a key part of their risk management story.
Okay, so defense seems robust, focused on historical discipline and low exposure to problem areas. What about offense? Beyond integrating Veritex, any hints about more M&A? There were rumors, Co-America, for instance.
The CEO was surprisingly firm on that. He basically shut down speculation about big M&A deals for now.
Really? Pushed back?
Explicitly. He said the primary focus is organic growth and making Veritex work. His quote was something like, "We have a lot on our plate." It signals they're serious about execution first, not just getting bigger for the sake of it.
So focus on organic growth and integration. Did they highlight any organic wins?
They did. They pointed to the Carolinas expansion, saying it's accelerating profitability well beyond what we thought was possible. So the organic engine is working too.
Got it. Last piece of the puzzle, capital. They want to build capital, get that CCT1 ratio up towards the middle of their 9 to 10% target range.
Right.
But at the same time, they announced a pretty significant share buyback plan. How do those two things fit together?
It does seem like a bit of a balancing act, doesn't it? Build capital cushion, but also return capital to shareholders.
Right. How much are they planning to buy back?
About $50 million per quarter, starting soon and continuing through 2026. That's a steady, committed pace, $200 million a year.
$50 million a quarter is pretty substantial.
It is. And doing that while building CCT1 sends a strong signal, arguably. It suggests they're extremely confident in their internal capital generation and future earnings power, especially with the stock trading where it is.
Confidence, or maybe just trying to support the stock price?
That's the debate, isn't it? Which brings us nicely to our This Is Not Financial Advice segment, where we cook up an outrageous but plausible trade idea based on everything we just heard.
All right, let's hear the outrageous trade. What's the pitch?
Okay, so the setup is clear. The market's painting all regionals with the same brush, punishing them over broad credit fears. Even Huntington's CEO noted their stock was down double digits recently, despite strong results.
Right. Indiscriminate selling.
But Huntington seems uniquely positioned against those fears. You've got that confirmed 2026 NEM hedge, the 10-plus basis point expansion that works even if rates fall, and you've got this committed, systematic $50 million quarterly buyback, providing a floor under the stock.
A structural defense on NIM and a capital return offense. Rare combo right now.
Exactly. So the credit fear arbitrage trade idea is this. Go long, Huntington. HBN, you're buying into that non-rate dependent margin story and the buyback support. Simultaneously, you short a basket of regional bank peers. Peers with higher NDFI exposure, maybe weaker credit metrics historically, or perhaps less clarity on how their NIM holds up if the Fed does start cutting aggressively. The thesis is straightforward. Huntington has a fundamental structural advantage, that fixed asset repricing tailwind, shielding it from the macro fear in a way the market hasn't fully priced in yet.
Yeah.
You're betting that difference will eventually show up in relative performance.
Interesting play. Arbitraging the specific fundamentals against the general fear. Okay, so wrapping this up. This Huntington quarter was really defined by, well, strong execution, significantly raised guidance on multiple fronts, and this Veritex deal set to boost Texas growth.
And all of that delivered against a backdrop of intense sector anxiety, with management offering what seems like a credible defense on credit, and maybe more importantly, that unique structural hedge against falling interest rates via IM.
So the final provocative thought for you, the listener, to chew on.
Is this dual commitment driving CCT1 capital higher while executing a steady, aggressive $50 million per quarter buyback the ultimate sign of confidence? Are they signaling absolute certainty in their future earnings and asset quality? Or is it simply a costly, necessary tactic to prop up the stock price while the market remains fundamentally fearful?
Something to think about. Thanks for tuning into this deep dive. We'll catch you on the next call.